For years, people were told this day would never come. They were told the silver market was stable, efficient, and under control. They were told price swings were natural, shortages were impossible, and anyone questioning the system was overreacting. But now, something has changed. The signals are too loud to ignore. The old playbook isn't working anymore. And for the first time in decades, it's starting to look like silver market manipulation is finally breaking. What you're seeing right now is not just another market cycle. It's the slow collapse of a system that depended on silence, complexity, and blind trust. A system that worked only as long as most people never asked the wrong questions. Those questions are now being asked, and once they're asked, they can't be unasked. Welcome back to the Economy Watch. I'm Daniel Carter. On this channel, we don't chase headlines. We break down what's really happening beneath them. And before we go any further, make sure you like this video and subscribe to the channel. It helps the Economy Watch reach more people who want clarity instead of noise, and it ensures you don't miss what comes next, because this story is still unfolding. For decades, the silver market followed a familiar pattern. Prices moved within narrow ranges. Sharp rallies were quickly shut down. Long-term scarcity never seemed to show up in the numbers. To most observers, it looked like proof that the market was healthy. But to those paying closer attention, it looked more like control than balance. Silver is not a large market. It doesn't take much pressure to move it. And yet, despite rising industrial demand, growing investment interest, and limited mining growth, prices remained oddly restrained. That contradiction became the foundation of growing suspicion. Not because of emotion or ideology, but because the fundamentals didn't line up with the outcomes. The mechanism behind this restraint was not simple, and that was by design. The silver market became dominated by paper claims rather than physical metal. Futures, contracts, derivatives, and financial instruments created the appearance of abundance. On paper, silver was everywhere. In reality, physical supply remained limited and increasingly difficult to replace. This system worked because it discouraged scrutiny. Most participants never wanted delivery. They wanted exposure. As long as contracts could be settled without demanding real metal, the structure held. Prices could be influenced without ever testing physical limits. That separation between price and reality became the core feature of silver market manipulation, even if it was never openly labeled that way. But systems like this have a weakness. They depend on behavior staying predictable. They depend on trust. And trust is fragile in times of economic uncertainty. Inflation, debt concerns, supply chain shocks, and declining confidence in institutions have changed how people think about risk. Slowly, quietly, behavior has started to shift. More participants are paying attention to physical availability. More industrial buyers are locking in long-term supply. More investors are questioning whether paper exposure really means ownership. None of these changes are dramatic on their own, but together, they change the balance of power inside the market. This is why recent developments feel different, not louder, just heavier. The system is being stressed in places it was never designed to handle. When price control relies on paper dominance, physical demand becomes a threat. And that threat grows when confidence fades. What makes this moment especially important is that manipulation doesn't end with an announcement. It ends when it stops working. When tools that once controlled outcomes lose their effectiveness. When reality begins to assert itself, not all at once, but consistently enough that suppression becomes costly instead of convenient. We are not at the end of the story yet, but we may be at the end of an era. An era where silver prices could be managed without consequence. An era where physical limits could be ignored. An era where complexity protected the system from accountability. In the next part, we're going to break down exactly how silver market manipulation worked for so long, why it was tolerated, and why the same structure is now showing visible cracks. Because once you understand how the system functioned, it becomes much easier to see why it's starting to fail. To understand why this system lasted as long as it did, you have to understand incentives. The silver market wasn't designed to reflect reality as much as it was designed to manage risk for large players. Banks, trading houses, and institutions needed stability, predictability, and control. Silver's relatively small market size made it easier to influence compared to larger assets. That influence didn't require secrecy. It required complexity. Paper silver became the perfect tool. Futures contracts and derivatives allowed massive volumes of silver exposure to exist without requiring massive amounts of physical metal. This created leverage. 1 ounce of real silver could support many claims on paper, as long as those claims were never redeemed for metal. At the same time, the system worked smoothly. This structure also shaped price behavior. When demand surged, it could be absorbed by paper supply instead of physical shortages. New contracts could be created instantly, keeping prices from signaling stress. To most market participants, this looked like liquidity. In reality, it was dilution. The price of silver was no longer determined purely by how much metal existed, but by how many claims could be written against it. Over time, this changed how people perceived silver. It stopped being seen as a scarce resource and started being treated like a financial instrument that could be expanded or contracted as needed. That perception was critical. As long as silver was viewed as abundant on paper, few people felt urgency to secure the physical metal. Another reason manipulation persisted was narrative control. Whenever questions arose, they were often dismissed as outdated thinking. Critics were labeled emotional or uninformed. Meanwhile, the system continued operating quietly, efficiently, and largely out of sight. The lack of visible consequences reinforced the idea that nothing was wrong. But there was always a trade-off. Every time paper supply replaced physical scarcity, pressure was pushed forward in time. The system borrowed stability from the future. That works only as long as future conditions remain favorable. And that's where the problem began. Industrial demand didn't slow down. Technology became more silver-dependent, not less. Green energy policies accelerated consumption. Medical and defense applications expanded. All of this increased physical demand that could not be satisfied by paper contracts. At the same time, mining failed to respond. Silver production remained constrained by geology, economics, and time. Unlike financial instruments, metal cannot be created instantly. It must be dug out of the ground, refined, and delivered. That mismatch between financial speed and physical reality widened every year. The result was a growing gap between what the market claimed existed and what could actually be delivered. For a long time, that gap didn't matter because behavior didn't test it. But now, behavior is changing. This is the critical shift. Manipulation depends on participation. It depends on people choosing convenience over certainty. As soon as enough participants prioritize physical ownership, the system loses flexibility. The levers that once controlled outcomes become less effective. What's important to understand is that this breakdown isn't caused by a single event. It's caused by cumulative pressure. Small decisions made by many participants, all moving in the same direction. That kind of pressure doesn't reverse easily. The silver market didn't fail overnight. It adapted, stretched, and absorbed stress for decades. But adaptation has limits. And once those limits are reached, control doesn't disappear quietly. It weakens, then fails in uneven and unpredictable ways. This is where cracks begin to show. Not as chaos, but as resistance. Price moves that don't behave as expected. Supply signals that don't align with narratives. Growing unease beneath calm surfaces. And once you notice those cracks, it becomes impossible to ignore what comes next. Cracks in a system like this don't look dramatic at first. They show up as resistance, as moments where the usual tools stop producing the usual results. For years, silver price behavior followed a familiar rhythm. Rallies were capped, breakouts faded, volatility was contained. That rhythm is no longer as reliable as it once was. One of the clearest signs of strain is how much effort it now takes to maintain control. Where a small amount of pressure once worked, larger interventions are required. That alone tells you something important. Control is becoming expensive. And when control becomes expensive, it becomes temporary. Another signal is timing. Price suppression used to happen quickly and cleanly. Now it often comes with delays, irregular moves, and visible tension in the market. prices don't always respond the way they're expected to. That unpredictability is not random. It's a sign that physical demand is pushing back against paper dominance. Inventory behavior adds another layer to this story. When physical silver inventories stop growing or quietly decline despite stable prices, it suggests that supply is being absorbed faster than it's being replaced. That's not how a well-balanced market behaves. It's how a stressed market behaves while trying to appear calm. Industrial buyers are also changing how they operate. Instead of relying on spot purchases, many are securing long-term agreements that removes metal from the open market for extended periods of time. Every ounce locked away reduces flexibility. And flexibility is exactly what a paper-heavy system needs to function. There's also a shift happening among investors. More people are questioning whether price alone tells the full story. They're paying attention to availability, delivery timelines, and premiums. These details matter because they reflect real-world conditions, not just financial models. What makes this especially significant is that silver is not easily replaced. When shortages emerge, industries don't have a backup option. They can't simply switch materials without consequences. That creates urgency that paper markets can't fully absorb. All of this pressure builds in silence. There are no alarms when trust begins to erode. There are no announcements when behavior shifts. But once enough participants act differently, the system responds whether it wants to or not. This is why manipulation doesn't end with exposure. It ends with inefficiency. When the tools that once worked start producing weaker results. When interventions create side effects instead of stability. When reality leaks through control mechanisms. We're seeing those effects now. Not as collapse, but as friction. And friction is the warning stage. It's the phase where outcomes become harder to predict, and maintaining the old order requires constant effort. At this stage, the question is no longer whether cracks exist. They do. The real question is whether the system can absorb them, or whether they will widen under continued pressure. And that brings us to the most important shift of all. Why this time is different from every other moment when people claimed silver manipulation was ending. And why those past failures may have actually delayed, not prevented, what's happening now. Every time the silver market showed signs of stress in the past, the system found a way to recover. Prices spiked, attention increased, and then control was reasserted. To many observers, this created the impression that manipulation could never truly end. But that conclusion misses an important detail. Those past moments failed not because the system was strong, but because the conditions were incomplete. In earlier cycles, physical demand was not strong enough to overwhelm paper supply. Industrial usage was smaller. Global production chains were less dependent on silver. Investor interest faded quickly once volatility cooled. The system had room to maneuver. It could absorb shocks, reset expectations, and continue operating largely unchanged. Today, that room no longer exists. The biggest difference now is persistence. Demand is no longer speculative or temporary. It is structural. Technology, energy systems, and infrastructure are locking in silver consumption year after year. This demand does not retreat when prices move or when narratives change. It remains constant, and in many cases, it grows. Another key difference is trust. In previous cycles, confidence in financial institutions was relatively strong. People were comfortable with paper exposure. They believed settlement mechanisms would always work. That belief is weaker today. Repeated economic shocks have changed how people think about risk. Certainty is valued more than convenience. There is also a timing issue that can't be ignored. Silver inventories are not starting from a position of surplus. They are already tight. When stress appears in a system that lacks buffers, it behaves very differently. There is less margin for error. Fewer tools work as expected. In the past, rising prices alone could cool demand. Today, many users of silver cannot reduce consumption without serious consequences. That changes how price signals function. Instead of discouraging use, higher prices may simply confirm scarcity. The financial structure itself is also more fragile. High leverage across markets means that stress in one area can spill into others more easily. Silver no longer exists in isolation. It is connected to broader questions about trust, liquidity, and the limits of financial engineering. This is why attempts to control outcomes now carry more risk. Every intervention pushes against tighter constraints. Every effort to maintain the old balance draws attention to its weaknesses. The system is still functioning, but it is functioning under strain. What people often misunderstand is that manipulation doesn't end when people talk about it. It ends when conditions make it unsustainable. When maintaining control requires more effort than letting prices adjust. When the cost of suppression outweighs the benefit. That tipping point is difficult to predict precisely, but its approach can be felt through resistance, through delays, through outcomes that don't align with expectations. We are not watching a sudden collapse. We are watching a slow loss of effectiveness. And in systems built on confidence, effectiveness is everything. This is why the current moment matters. Not because it guarantees a specific outcome, but because it removes the certainty that the old outcome will repeat. The assumptions that protected the system in the past are no longer reliable. And when assumptions fail, markets are forced to rediscover reality. When control finally starts to weaken in a market like silver, the effects don't stay neatly contained. They spread outward, touching institutions, industries, and eventually everyday people who may not even follow markets. The first change is usually price behavior. Not just higher prices, but different prices. Moves that don't reverse as quickly. Rallies that don't fade the way they used to. Volatility that feels less controlled and more reactive. This is what happens when price discovery begins to matter again. Prices stop being tools of stability and start becoming signals of scarcity, stress, and shifting confidence. For banks and large institutions, this creates a difficult environment. Systems built to manage predictable ranges struggle when outcomes become less certain. Paper markets rely on orderly behavior. They rely on participants acting rationally, rolling contracts forward, and accepting cash settlement. When physical silver becomes harder to source, that behavior changes. Participants start paying attention to delivery terms, counterparty risk, and real availability. Even if most contracts are still settled without delivery, the mere possibility of stress changes how people act. This is where credibility becomes the real issue. Markets function on trust. Once trust begins to weaken, rules that worked for decades can lose effectiveness very quickly. Institutions don't need to fail for this to matter. They only need to be questioned. For industries that depend on silver, the shift is more practical than psychological. Unstable pricing and uncertain supply complicate planning. Long-term contracts become harder to negotiate. Costs become less predictable. This doesn't stop production overnight, but it introduces friction. And friction slows everything down. For everyday people, the effects are indirect but real. Technology costs rise. Supply chains become more fragile. Products take longer to reach market. Silver may be a small component in many items, but it is often a critical one. When that component becomes harder to secure, it creates bottlenecks that ripple through the economy. There is also a broader implication that goes beyond silver itself. When people see that a long-controlled market can change, it challenges assumptions about other markets. It raises questions about how many prices reflect reality and how many reflect structure. That kind of questioning doesn't stay focused on one asset. This is why moments like this matter, not because they promise easy answers or guaranteed outcomes, but because they expose how systems really work under pressure. They remind us that financial engineering has limits, and that physical reality eventually reasserts itself. What happens next doesn't have to be dramatic to be significant. Even a gradual shift toward more honest pricing changes incentives across the system. It alters how risk is measured, how capital is allocated, and how people think about value. Silver doesn't need to become the center of the financial world for this to matter. It only needs to stop behaving the way it always has. And signs suggest that change is already underway. Which brings us to the final and most important part of this story. What this shift really means, how to think about it calmly and clearly, and why awareness matters more than reaction. At this stage, The most important takeaway is not that silver prices must explode or that the system must fail overnight. The real takeaway is simpler and more powerful. A market that relied on control is being forced to reconnect with reality. And that reconnection, once it begins, is rarely reversible. Silver market manipulation didn't survive because it was perfect. It survived because it operated in an environment that allowed it to. That environment is changing. Physical demand is persistent. Supply is constrained. Confidence in paper systems is weaker than it used to be. Those forces don't need to agree with each other. They only need to exist at the same time. This is why the phrase, "it's over," doesn't mean an ending. It means a transition, a shift away from a system where outcomes could be managed quietly, toward one where outcomes are shaped by limits, trade-offs, and real-world pressure. That shift doesn't happen all at once, but once it starts, it tends to move in one direction. What makes moments like this uncomfortable is uncertainty. Controlled systems feel safe because they're predictable. Reality-based systems feel unstable because they respond to conditions, not expectations. But in the long run, reality is the only thing markets can settle on. For anyone watching this, the goal is not to panic or to chase narratives. The goal is awareness, understanding how a system worked, why it's changing, and what that change represents gives you clarity. And clarity is valuable in times when noise is everywhere. At the Economy Watch, that's exactly what we focus on. Not hype, not fear, just clear explanations of how economic systems evolve and why certain moments matter more than others. Silver is one of those moments, not because it's flashy, but because it quietly exposes the limits of financial control. Now I want to hear from you. Do you believe silver market manipulation is truly breaking? Or do you think the system will adapt and regain control once again? Share your thoughts in the comments. Different perspectives help everyone understand this issue more deeply. And if this video helped you see the silver market in a new way, share it with someone who cares about economics, markets, or the future of money. These conversations are most valuable before changes become obvious. Make sure you're subscribed to the Economy Watch, because we'll continue breaking down the stories that shape the global economy long before they dominate the headlines. I'm Daniel Carter. Thanks for watching, and I'll see you in the next one.